So what's going on in the labor market? What do we see in 2026?
When we go underneath the headline numbers, what we're actually seeing are two different areas. There's a need for a lot of vocational labor. At the same time, we are seeing it difficult for many coming out of college. We're hearing about potentially companies slower to hire because they're trying to understand what AI could potentially do for productivity. And that's really been targeting sort of the entry-level types of white-collar job. The headline numbers show one thing, but once we look underneath the hood, we're seeing a couple of key labor trends.
Welcome to the Aprio Ascend podcast, where we help business leaders stay ahead of what's next in finance, strategy, and growth. I'm your host, Jordan Fladell, and today we're breaking down Aprio's 2026 economic outlook. What's real, what's noise, and what business owners need to do this year. We'll hit 10 rapid-fire questions with our guest, Simeon Wallis, Chief Investment Officer at Aprio, to help you navigate the year with clarity and confidence. Well, let's go ahead and jump on in right here. Simeon, as we begin to enter 2026, what's the real economic setup? What's going on out there?
So we're excited about 2026. We're very optimistic on this year. We're coming into a year with the economy that has been growing. And as we look forward into 2026, we're going to see a re-acceleration. And in fact, we're actually seeing that in the numbers here in January. And there are a few key reasons why. The first is liquidity. There's more money in the system for 2026. So we know that the Fed is lowering interest rates. They're expected to lower it twice this year. On top of that, we get the benefit of those bills that were passed in 2025, the OBBBA, where we will get fiscal support for the economy in the form of tax cuts for individuals as well as for corporations. So those provide two real strong tailwinds into this year. And then on top of that, we have two idiosyncratic events for 2026. The first is the World Cup coming here to the US. That should really help a lot of travel and leisure locations here in the US as international travelers come here. And then on top of that, we have the 250th anniversary of our country. That should lead to a lot of patriotic spending. And as we go into the summer to really celebrate our 250th anniversary, we saw a big pickup 50 years ago when we celebrated the 200th anniversary. So we do think that should create a tailwind. All of this should make the first half of the year, if not going into the third quarter, much stronger than prior years. And estimates are for an additional percentage of GDP growth above our normal trend growth rates, Jordan.
Well, that's really interesting. As part of this, are interest rates going to remain high because inflation is coming down, right?
So inflation has been slowly or gradually coming down. The expectation for interest rates are that we're going to have 25 basis points or a quarter of a percentage point cuts in 2026. But it's important to understand the timing of that. First cuts are not expected until this summer, and then a second potential cut later in the year as we get towards the end of the year. And that's really because we have a new Fed chairman that will come into play in May 2026. And it's unlikely that Chairman Powell is going to have rates lowered before that point in time. So we're really looking at two rate cuts this year, one in the summer, one later in the year.
So as we talk about the U.S. consumer, right, how important is it to have a strong U.S. consumer to the reality of what's going on in the market?
It's extremely important. Remember, the U.S. consumer is about 70% of the U.S. economy. And that falls into two important buckets. The first is we have what we call the secure consumer. So think about people who typically make more than the median income, or they're later in their career. They can even be early retirees that have basically over decades accumulated wealth, and they're still spending. The flip side is what we call the stretched consumer. These are typically people who are earning below the median income or who are earlier in their careers, so think mid-30s and younger. And for the most part, they've been renters. They may not have had a lot of money in terms of assets in the stock market or owning real estate. And as a result, they've been stretched the last few years. Now, 2026 is important because if you remember in the legislation passed last summer, there is a lot of tax incentives that were put into place, and we'll start to see that hit in February and March of this year. So we're thinking that the average consumer may have somewhere around $1,000 or $1,500 more in their pocket this year than in prior years, just from tax refunds. And so that should be a real benefit to the economy, especially in the first half of the year.
So, Simeon, that would be one of the impacts of the One Big Beautiful Bill. I was actually reading something about that this morning. Expected larger returns for people filing this year on income tax. So, good to hear you validate that here on the Aprio Ascend podcast.
Yes, by order of magnitude, we're looking at typically it's been $3,000, $2,500 to $3,000 that have been what consumers have received in terms of refunds, and now it's looking like over $4,000. So it's pretty significant.
Wow, so some good liquidity there for consumers who either are paying down their debt or putting that money back into the to market to grow our economic conditions here in the U.S. So what's going on in the labor market? Is the labor market loosening because of this? Is it tightening? What do we see in 2026?
Yeah, the labor market's been perplexing for many because we've seen low unemployment filings, but at the same time, we've not seen really wages increase. So they've been actually decelerating, and so we've been in this stasis for the most part within the labor market. But when we go underneath the headline numbers, what we're actually seeing are two different areas that are really important to understand. The first is that there is a real skills mismatch. There's a need for a lot of vocational labor. If you think about what's traditionally been called blue collar labor, there's increasing demand for that as baby boomers retire out of those industries. And we haven't had really the backfill for the most part in certain parts of the economy. At the same time, we are seeing it difficult for many coming out of college to move into traditional white collar roles. And some of that is because in the pandemic, many companies overhired in that segment of the market. And so they've been paring back as growth has slowed for a few years relative to where it was in 2021. And at the same time, we're hearing about potentially companies slower to hire because they're trying to understand what AI could potentially do for productivity. And that's really been targeting sort of the entry level types of white collar jobs. So it's not that they're letting people go in those markets, but they're just slower to hire than in the past. And so the headline numbers show one thing, but once we look underneath the hood, we're seeing a couple of key labor trends.
Yeah, so I think that's actually very interesting in the world of artificial intelligence, the blending of HI and AI, as we just talked about with Alice, one of our previous guests. That need for what I call that worker who, in those what we call traditionally blue collar professions seems to be a void in our market, an opportunity for young people to double down and grow in the initial parts of their careers.
It absolutely is. And those are often skills that take some training, some vocational learning, but they're also the types of things that people can get a lot of satisfaction for having done a job well done. We've just moved away from that as an economy overall over the last few decades. And hopefully we're going to see that reignite because that's really a big area. Oftentimes these can lead to six-figure incomes for people earlier in their career, but it's just not been something that traditionally we had been looking at as a real career path.
Well, Simeon, is inflation really under control? I mean, we've heard a lot of noise in the market about inflation, of people feeling it in the grocery stores and elsewhere in their world. Are we at a place now where we feel comfortable saying it's under control?
I don't feel like we can say it's under control. I would say that it has slowly been moving in the right direction, but we've had some real benefits, especially over the last year, that have helped with that. For example, energy costs have really been very muted. Oil prices were down about 20% last year. We don't know if that's repeatable. Additionally, we are seeing some benefits from areas that were very discretionary in nature. So purchases where we didn't have to necessarily buy things. So think about electronics, apparel. We've seen prices there also decline pretty significantly over the last year. And then the third part that's real important for inflation is what we call the cost of shelter. So how much does it cost if you're a renter to rent a home, or if you're a homeowner, the equivalency with which you can rent that space out if in theory you wanted to. And we've seen those shelter costs very slowly come down over the last year or two. And so this has all been a real positive benefit. The flip side, though, is that we are still having inflation in areas that stick with us where we really would like to see it turn the other way. A good example of that is insurance costs continue to rise, whether that's healthcare insurance or property and casualty insurance, as the cost of insuring in areas such as California and Florida, where we've really had some environmental challenges, that has really continued to stick in people's pockets. And so because that has not come down as fast as we would have liked, overall inflation has not moved down as fast as we would have liked.
Definitely some concerns here on those expenses when it comes to inflation that's hitting our wallet directly on a daily basis. We've talked a lot about the return, or the beginning of the return of capital markets. Are we looking at a very attractive M&A window in the first half of the year, maybe the second half of the year? What do you think is going to happen in the world of M&A?
We're just getting started. This is actually expected to be 2026, and we think even into 2027, very, very strong years for M&A transactions in general. A few key reasons why. So the first we hit on, interest rates are likely to come down a little bit more. That helps with create liquidity, lower financing costs for deals to occur. The second, and a very big one, is that the regulatory environment is much more accommodative to acquisitions. And that could be acquisitions by other corporations, so what they call strategic acquirers, or what's going on with private equity firms and the private markets. There's liquidity available. Companies can borrow from banks and take out loans, or they can borrow in private deals, which we call private credit. All of that is very liquid and the markets are very accommodating. And then on top of that, the regulatory environment and competition, we've had a change in administrations and we're starting to see what the new perspective is. And there seems to be a deal environment that would be very strong. So it started to pick up in the second half of 2025. 2026 looks like we can really accelerate. We know that pipelines are full. We heard it from companies reporting earnings, investment banks talking about how strong the deal pipeline looks. And so we're very excited about that for this year. And ultimately, that should help even real estate, because real estate tends to be a follower of what goes on in corporate M&A activity. So we're very optimistic about it as we look forward.
Yeah, so simple message here, folks. I think what Simeon's telling us is that between the administration, the potential attractive reduction in rates, there's a lot of opportunity here for consolidation in the world of M&A. So look for frothy activities here in 26 and 27. So what do you see as the biggest risks in the economy in 2026? Like, what are the things that could derail some of the positive trend lines we've set off over here?
Two key risks we're really focused on from where we are today. The first is what we call the return of the bond vigilantes, or focusing on what are long-term interest rates likely to do. The short end of the curve, what the Fed controls, is likely to come down a little bit. But the area where the bigger question mark is the longer term rates, where investors are trying to understand what's the likely impact of inflation and government spending. Is it moving in the right direction? And that's where we focus on the 10-year bond. And if the 10-year bond moves over 4.5%, we could see the prices of stocks, of real estate, if not decline, then stagnate. Considering that the consumer that has been driving this economy have been wealthier consumers that have really benefited from the rise in stock prices and of real estate over the last decade overall. If we see a reversal of that, we could see that start to filter through the rest of the economy. So the long end of the bond yield curve is one thing that we're looking at. The second are geopolitical risks, specifically if China does move into Taiwan and there's some impact on the supply chain for semiconductors in particular, considering how pervasive semiconductors are in everything from artificial intelligence to automotives and other parts of our life today, that could also be a real significant risk. So we're really focused on those two primarily. The AI spending is a corollary to that risk in terms of what goes on with Taiwan. That would be another area that we would be concerned about.
If I'm a business owner and I'm looking and I'm just getting started here in 2026, and obviously everyone finished planning in 2025, but I'm now listening to this podcast, what do I have to think differently? What would I do differently that maybe I should be doing that wasn't on my list to do for 2026 as of yet?
Well, the first is I would really lean into the growth opportunity that we're going to see that at least is the first half to 2/3 of the year. We talked about liquidity helping. We haven't talked about this productivity revolution that is really starting to pick up and gain some steam that we'll see play out in 2026 and 2027. It's not just AI, but it's other form factors of AI that will have an impact on productivity. So think about things like robotics, the self-driving cars, or automated vehicles is another key one. The use of drones, all of these are coming together at the same time that can really enhance productivity within companies. Additionally, we have this year the World Cup coming to the US. That should help grow, especially for any sort of travel and leisure related industries here in the US. And then on top of that, we have the 250th anniversary of the US. We expect a lot of patriotic spending leading up into that as we have those celebrations. So the first half of the year, we believe companies should really lean into growth and do what they need to do to capture that. As we move towards the back half of the year, some of the stimulus does start to wind its way down. So again, let's say, the tax refunds for consumers. So think about how to make that pivot to be a little bit more balanced between growth and cost management as we get to the latter half of the year. Those would be two areas. And then the third, thinking about financing. As we mentioned, we expect 2 rate cuts, but those are not likely to happen until the summer and then towards the end of the year. So don't let an expectation of just waiting for rates to go down before making business decisions. If you do have an opportunity, it's worth leaning into spending on CapEx and other areas where you may require some financing, since you'll have some tailwinds, but they won't be significant drops in rates unless we have something more significant happen to the economy.
Well, that's awesome. So I know you touched on this briefly in the conversation earlier. You mentioned the word real estate. So really, what is the outlook for real estate this year?
It's nuanced in that we believe the bottom in asset valuations have already hit across commercial real estate in particular. When we look out multiple years, we think now is a good time to be more active in real estate. At the same time, we are still going through this clearing out process. There are assets that do not have the right capital structure, but we expect that the transactions needed to essentially clear the market, flush it out of those properties that don't have the right valuations, that might have too much debt, that will start to really happen this year further. We think that the corporate M&A environment allows for the market to be more active, for lenders to essentially take their lumps and move forward. And so we do think that the real estate market should be good. Within that, though, what we're seeing across different parts of commercial real estate in particular are that the real strong assets, the Class A assets, they're doing very well. And we would expect that NOI growth should be strong across those. When we start moving into Class B and Class C assets, it's a bigger question mark. And especially with some of those lower performing Class C types of assets, maybe they don't have great amenities, maybe they're 30 or 40 years old and they require a lot of capital to come in to refresh them. That's the part of the market that we would expect to struggle. So understanding where assets sit between Class A, Class B, Class C, extremely important as we think about real estate overall. And then on the residential side, we expect that it's still not going to be a great environment, but if we do get mortgage rates to continue to march down over time, going below 6% and hopefully getting to around that 5.5% range, then we would expect to see more activity pick up within residential real estate.
So part of our tradition here in the Aprio Ascend podcast is to talk about your Aprio Ascend moment. And so I've kind of framed this for today for you. If you as a business owner, right, you have one moment in time here, what's the one Ascend moment or piece of advice you would give to a business owner today in your shoes as our Chief Investment Officer here at Aprio?
When we're thinking about over the next 3 to 5 years, is to really understand that what happens with AI is going to impact every industry, and often in ways that we can't quite predict today. But to allow you and to allow your employees to experiment and to lean in with ways that it could potentially make your business stronger. So that could be looking at things like how to change workflows. You could also be looking at how to go a little bit more on offense, using it for lead generation. But most importantly is to get comfortable with the fact that things will change and that you have to be in the arena, so to speak, to help figure out how to best do it for your own personal business.
Well, thank you for that Ascend moment, and thank you for joining us, Simeon. We'll see you next time.
Thanks, Jordan.
Thanks for joining us on the Aprio Ascend podcast. If you found today's outlook helpful, share this episode with a few business leaders. For deeper insights on strategy, tax, M&A, and transformation, visit aprio.com. Until next time, keep learning, keep leading, and keep ascending.